All right, so first question, explain the objectives of the evaluation report. So the evaluation report is the most important, as you've probably seen, right? You critique one, right? It's the most important deliverable. That is the work product of the evaluation analyst, right? And ultimately, it serves two purposes. Number one, if it's a evaluation report for litigation purposes, for example, it gets submitted to the court, and the evaluation analysts will get deposed over it, meaning, the opposing lawyers can sit down with them and ask them questions about it, try to discredit some of it, right? The opposite side's goal is to discredit the report, essentially, to say, show mistakes in it, find mistakes, show that, maybe there was evidence of bias because of, whatever it is, right? Because they want the report to be favorable. They want the judge to find favorable towards their client rather than, the other side. Now, the most important thing to remember is that as evaluation expert, you're not supposed to be an advocate. Generally, you're supposed to be. In the video that I gave you, generally speaking, you work for the judge. You don't, So the idea is you want to try to provide an unbiased view, right? You cannot be overtly biased in those reports. Now, under some circumstances, you can start serving as an advocate. But generally speaking, the goal here is, it's okay to have legitimate differences of opinion, but you have to be very careful on what you put in this report because you cannot be overtly biased, right? And it's also very important not to just do what your lawyers tell you. Like you work for the lawyers, right? You work with the lawyers, but whatever you do in this evaluation report has to follow standards of practice. So if you're a CPA, you'll follow the evaluation standards of the AICPA. You follow the standards of the Appraisers Institute, whatever. But the bottom line is, it cannot be stuff out of thin air. It has to be grounded in literature. And it has to be reasonable. It has to be reasonable. Reasonable, what does reasonable mean? Reasonable means defendable, right? So, you can't just say, oh, I believe the cost of capital is 10%. Why? You can't just say, well, I'm going to increase the cost or reduce the cost of capital, increase the cost of capital or decrease the cost of capital by 2%, because I believe that's what the right thing to do. And I've actually listened to, and my law from Washington, D.C. area to Baltimore, I listened to this wonderful AICPA Evaluation Services podcast, and they interview a lot of practitioners. And I've posted some of those podcasts for you to listen to. And they're really worthwhile to listen to, especially if you're thinking that this is something interesting to the profession. And listening to some, and they were saying, look, that's what you sometimes see. People just basically put something on paper and they don't provide any support, right? And that's what gets you into trouble. There's something called Dolbert's challenge. And it's a motion that the lawyers of the opposing side could bring to completely strike down your testimony. Basically say, all of this person made serious about this is just be sticking down from the record. And this is a reputation and career killer. So as I hear these people, and I myself have never testified, but as I listen to them, they seem to be less concerned about, well, the judge will disagree with me or the jury will disagree with me. They're more concerned about people will point to me, will find something that I did or said that is just wrong, and that will be a career and reputation killer, right? So, by definition, you win some, you lose some, right? Because and one of them said, well, the problem is that when ultimately this is going to, let's say you testified, the opposing expert testified, they got their report, they got my report, whatever. And then jury finds what it finds. And oftentimes it may not find for your party, but it has nothing to do with you, right? So you're just a piece of a puzzle. But the bottom line is, evaluation report is your proof of work, and it needs to be pretty cleanly done proof of work. So everything you put there has to have some support, some citations, be grounded in sort of acceptable literature. So it was interesting to know, Strugman is obviously a pretty authoritative book, right? But there is also a book, one of the perhaps, foremost practitioners of private company valuation, sort of a counterpart was Aswad Damodaran using the public companies, is the gentleman who just recently passed away by the name Shannon Pratt. Shannon Pratt, P-R-A-T-T. And he has a book on business valuation, which is in the valuation community considered like a legal treatise almost like, right? It's about this thick, I have it on my shelf. It's not it doesn't work as a textbook, like Krugman's book. But, that is referring to him is considered kind of like a good standard, right? Like whatever he says to do is considered authoritative, right? In that literature, right? So, it's a good idea. If you ever go to that, to acquire this book as a reference. There's another gentleman by the name is James Hutchner, and I have not the actual book, but this is the workbook, right? Just like I have a workbook for. He has a book called Financial Valuation, also about this thing. Also kind of gives you, it's published both Pratt's books and Hutchner's book. And actually, the majority of those books you've seen, they're published by Wiley because it tends to publish it. So it's good to have it in your library. And it's, it's a good idea to, when you write the report, to refer to, these books, to articles. There is a magazine or academic journal called Journal of Forensic Economics. It publishes kind of called, they're more like scholarship on valuation and damages and whatever it is, right? So you may want to try to, anytime you make a claim in the report, it needs to cross-reference something. Obviously, if you're using comparables, it needs to, of any sorts, it needs to cross-reference either deal stats or capital IQ. And I was listening to the man today on this podcast, and he said, what's interesting, you kind of claim that deal stats oftentimes omit certain types of, it doesn't have necessarily all transactions. He said, well, it's always a good idea to dig around the internet and see, because a lot of this sort of additional transaction data, multiple data from investment mix, it comes out in the industry surveys. Duff and Phelps, actually Kroll, formerly known as Duff and Phelps, publishes the cost of capital survey, goodwill impairment survey. So all of those are good resources to reference in your report. It sort of gives you, the more you do that, the more you come across as you know what you're doing, you know what you're talking about. Doesn't mean you have to agree with it, but it gives you the foundation in front of the judge. It gives you the credibility. So what is the difference between detailed and summary valuation report? As it describes, detailed valuation report is what you saw. You gave critique on, right? The summary valuation report is shorter, it's more condensed, kind of omits certain sections. Basic information should show up in the detailed valuation report. Actually, if you really want a checklist, I would, Pratt has a very good checklist, like of what valuation report should have. So obviously it should say, it should have information about you, who you are, why you're doing it, what's your expertise, what you're valuing, what standard of value, fair market value, fair value, you're using. What is the valuation date? And as you know, and we'll even talk about in the context of divorce today, valuation date is non-trivial, right? So if it relates to some sort of a litigation over damages, shouldn't be as of the date of the court, so the date of the judgment, should be the date of the damages were were caused. All of those things, and it depends on the state, depends on what your lawyers tell you, but you have to be pretty explicit. So number one goal of the valuation report, it has to describe the work that you did and provide support for your conclusions in the most detailed possible way so that people could ideally replicate what you did. So in one of those podcasts, that's exactly what the person said. He said, look, ideally, our standard evaluation report is that we put everything so that some people could just replicate over. And he said that their evaluation reports could go up to 100 pages long. Now, some of the required elements of an evaluation reports are, for example, it needs to have a thorough analysis of the business and microeconomic environment of the company that you're trying to value, an entity you're trying to value. The worst possible thing that you could do is go to some database, download, like there's databases, even in our library, you can download the big surveys of industry, something like that. So actually, in fact, it was even mentioned in one of the recent weekly emails that I get from PBR. There was a very embarrassing case where an expert basically did exactly that. They went, downloaded some industry report, some database, and instead, like, you could use it, you could cite it, you could quote from it, but all this person did is simply just pasted it in the document. Well, that first, and but it's also plagiarism. I mean, I don't know if they provided attribution or not, but it's like, plagiarism is not just citing without attributions, it's basically excessively cutting and pasting the text even with citations. That's not their work, right? How do you know, like, okay, some database said this and that? Well, like, but we don't know if that's true. Where's your value? Where's the critical thinking that, right? Ideally, you want to collect them from, your industry analysis or economic analysis. You should cite multiple surveys. You should cite analyst reports if it's a public company. You should be as comprehensive as possible to give as broad a picture as you can to do that. So industry analysis, basic financial statement analysis, like ratio analysis, trends analysis, analysis of profitability, of cash flow should be present. The other element, basically, you need to also kind of normalize the financial statements, right? By normalization, I mean, take out any sort of try to estimate what is the real persistent component of earnings, sales, and costs. Take out any sort of unusual items. Forecasting data should be present. Sources of forecasting data, explanation of assumption for forecasting, where you got it from. Obviously, and multiples, the actual variation. And in the end of the day, the expectation is that to the extent you can, you should try to, unless you are not allowed. In certain cases, you're not allowed. We'll talk about that, right? If you use the market-based approach versus income-based approach, you should also try to reconcile. If they're highly different, try to reconcile that, right? So how does evaluation analyst signal their competence with the evaluation report, and what sorts of things should be avoided in the evaluation report? So I'll give you one example, right? Don't cut and paste stuff. Try to be comprehensive. Your value is not on copying information. So it was interesting today that this person was saying, well, like ChatGPT, artificial intelligence. Like, I'm not afraid of ChatGPT. I'm not afraid of ChatGPT because in many ways it will make our job easier. It will make our search for information easier. The key element is that you take whatever ChatGPT produces and then critically assess it, put it in the context, right? But a lot of time, for example, with respect to ChatGPT specifically, it's still somewhat inaccurate in certain things. I've seen it. It's great with some things, and for example, I use ChatGPT in one of my co-author use it to search for any papers we may have missed in our literature review. Well, it wasn't very helpful because all it did is basically said, it didn't even say which paper. One paper said that, another paper said that. Which paper said, which one said, didn't provide citations, nothing. Right, so this evaluation report, to the extent it's grounded in supporting literature and research and data, in actual objective data, all of that needs to be in it. It shows that you understand what you're doing. An extreme example of not to do was given in one of the interviews I was listening to is, well, he said, normally, like, we write a 100-page report, and this other expert wrote a 6-page report, and when was asked to explain why he's like, that's what I believe. That's my right? That's not what to do here, right? What types of criticisms do the evaluation report want to envision? What are common mistakes analysts makes with their evaluation reports? Like, for example, you've seen it, right? You were working on the critique today, right? You using the wrong standard of value. Double count. So there's a big debate about double counting, right? And what is that debate entail? Discount for lack of marketability. If you're using it, meaning you're actually discounting the value and apply the value in the end, should not also be at the same time increasing discount rate itself, right? The cost of capital in the denominator to account for lack of liquidity. You can't do this. You're not supposed to do it in both places. So things like that, right? Kind of conceptual mistakes. Discuss basic valuation certification and the types of engagements that are applicable. Well, I've actually posted a bunch for you, right? So, if the easiest one to get is the CVA, Certified Valuation Analyst. I don't remember if it requires X number of hours of actual valuation practice. If it does, it's not huge. But there's an exam, basically kind of, or like you write a case essentially and present it and they judge it. It's granted by an organization called NACVA, NACVA, National Association of Chartered Valuation Analysts. There is also, the Druckmann book is written for curriculum of ABV, accredited in business valuation. And that's a credential that American AICPA, which is no longer American Institute of CPAs, but Association of International Certified Professional Accountants, the AICPA, right? Formerly known as American Institute of CPAs. It's a credential developed for CPAs, CPAs, like I have a CPA license. If I wanted to do valuation, I would go and get this additional certification called APV. So there's an exam involved, but more importantly, which I was actually looked into it for myself, and it does require essentially, I think almost like 1,000 hours of actual work and valuation to be able to get the credential, right? So in other words, you can't just go and pass the exam and get it. You have to have worked somewhere. Get it. There is ASA, which is Associated Society of Appraisers, which is a very, very highly respected credential, probably the most respected of them all. I mentioned that if there's a certification developed specifically for people that work in valuation of public companies, like on goodwill and intangibles. If you're interested in that, I think CVA would be. Obviously, if you work in finance, then CFA, Chartered Financial Analyst, is a great designation by itself. That is the golden standard for anybody who works in financial services. The hardest certification to obtain. Pretty much, I think, of all of them, right? For example, it's much harder to get CFA than to get a CPA. It requires a lot more. It's 3 exams, it's 3 levels. So that's kind of my review of what you guys, I hope, did last week at home, right? It's kind of high-level review on valuation practice. I posted I think 2 or 3 podcasts from this AICPA Valuation Services podcast. I don't expect you to memorize and take notes on them, but again, what's valuable about them is that they talk about the interview real professionals in the job. It's like having a guest speaker. Except you can ask questions, but I found them to be very insightful. All right. So that's kind of a review of Module 7. Now let's talk about. Let's talk a little bit. divorce and